Welcome to the Bullington Capital Report, hosted by Bill Bullington. For the next hour, you'll receive information on current market conditions and trends that could affect your financial future. If you have a question for Bill, you can participate in today's program by calling 216-901-0945. That's 216-901-0WHK. You can also reach Bill by going to his website, bullingtoncapital.com. So without any additional delay, here's the host of today's program, Bill Bullington.
Well, welcome back. Just reading something here real quickly. Hey, if you have a phone call, question, or comment, 216-901-0945. I'll just start by throwing that out there. I've gotten quite a few questions over the past couple weeks regarding what do I think the Trump administration is going to do to the economy. And quite frankly, we're going to spend 15, 20 minutes talking about it. I don't think it's as significant as a lot of people do, but, they have to sell ads and sell newspapers because that's what they do, or get clicks on their websites, which is an entirely different thing. But before I do any of that, I really want to kind of take just a second and talk about the seminar I got coming up. It's I have to actually look it up, by the way. We're going to be talking about value investing, which I think is kind of a timeless thing. There are multiple styles. This is probably one of the more popular styles of investing out there. It's trying to figure out what a stock is actually worth and then try to pay less for it, hoping that at some point in time that price gets corrected and or just not overpaying. In a lot of cases, just not overpaying for stocks is can be 90% of the battle. So anyway, we're going to be talking about the Intelligent Investor Updated. That's the name of the seminar, the Intelligent Investor Updated. And based on a book written in 1949 by Ben Graham. If you don't know who he is, he was Warren Buffett's graduate school teacher and one of his first employers. And he was a hedge fund manager. They were all called partnerships back then, limited partnerships. They're still called that, by the way. Hedge fund is actually a slang term. So anyway, Ben Graham wrote this book, and he was really known for the book called Security Analysis, which for decades was kind of the Bible of value investing for value investors everywhere. Anyway, we're going to take some of those principles from that book, and we're going to be talking about the modern versions of those basic ideas. So I've updated it. In fact, the two of the models that I run at Bullington Capital, one of them is the what I call the high dividend model, and the other is called the BCAP value. That just stands for Bullington Capital Value. Those two are based on the same premises that Ben Graham wrote about all those years ago. And incidentally, his lifetime track record I've read in Warren Buffett's authorized biography was about 14. I think that's where I read it. I could be wrong, by the way. I read a lot. Sometimes I forget where I read something. But anyway, it was 14.5% a year. And at one point in time, he went through the correction of 1929 and the Depression. He was down reportedly around 70%. So to be down 70% and still to be able to come back and have a 14.5% lifetime average is amazing. It's amazing. Think about that for a second. So this guy was investing through the Depression. Invested, I think he retired in the early to mid 50s. And that's when Warren Buffett started his Buffett partnerships, which became Berkshire Hathaway. And most of you probably have heard about that. Well, anyway, this book actually had a significant and profound impact on Warren Buffett. He signed up for the Columbia MBA program, took the investment analysis course that Ben Graham taught, was one of the few people ever to get an A. Then he ended up a couple years later working for him until Ben Graham finally retired, shut his fund down, and then Warren Buffett went out on his own. So a lot of the same concepts, they're available today. The markets have evolved somewhat. We're going to talk about that in a little bit on the show, how markets evolve. It's probably not like a large number of people think they evolve, but markets do evolve from time to time. They make slight changes. And the intelligent investor, a lot of the concepts, the basic concepts are still valid, still work. Probably not like you'd like them to, but they still work if you work them. And we're going to be talking about that in great detail and how some of this might fit into your retirement portfolio. As retirement's tough. It's really tough if you haven't made enough money or you haven't invested enough money or you haven't done a good job investing. It makes it incredibly difficult. So, and these particular styles are more traditional. They're kind of the buy low, sell high approach. It's you're trying to buy lower. How do you know when something is low? Well, with the dividend stock, it's because the dividend yield is really high. With a stock that doesn't pay a dividend, maybe it's a smaller company that's growing pretty well, growing fast, but it may not pay a dividend, but the amount of cash that the company's generating might be a large percentage of the actual price that the company is selling for. So if you're getting a small company with a 10 or 15% growth rate that has 10% cash flow, if you were to buy the company and got to keep all the cash, you're making 10% on your money and it's growing by 10% or more a year. That's a good thing. How do you recognize those? Well, that's what we're talking about at the seminar. I'm going to show you how I do it. And if you have the gumption, you could do the same thing. That's one of the things I'm very keen about is showing exactly what I'm doing. There are no mysteries. I stay around and answer questions after each one of the workshops. This one's going to be a little bit shorter because, quite frankly, these concepts are not that complicated. And they're just really, or at least knock on wood, they have been very effective. And I get it. I know why they're effective because they're based on something real, some things that you can measure. Things that you can measure. I should write a little blog post on that, and probably I will. You should stick to things that you can measure. Okay, when you're talking about stocks. I take questions on this radio program all the time. And feel free to call today, by the way, 216-901-0945, 216-901-0945. Feel free to call and ask a question. And I ask a lot of questions, or I get a lot of questions. And most of the time, the questions I'm getting are questions that really do not have good answers. So, and realistically, if you want to do really well and you want to step up your game in the investing world, you need to try to focus on those questions that you can answer positively and have at least a 90% chance of getting the answer. And what do I mean by that? Well, I can measure exactly how much in a dividend yield is. I can measure that. That's really easy. I take the dividends they've paid over the past 12 months divided by the share price. That's it. There's no questioning that. That's a fact, okay? Is that fact going to change? Yes, it will. Yeah, it'll either improve or it'll deteriorate. They never stay the same. Okay. But you can know for a fact what the trailing 12-month dividend yield is, beyond a shadow of a doubt. You can also know how much operating income the company has produced. That's basically a version of cash flow. So how much cash they generated, you can look that up. That's a real number. You can take, and it's, by the way, that number's actually more accurate oftentimes than the earnings. That's why I'm not using the earnings. Because earnings, in my opinion, are an opinion. 8,000 pages of generally accepted accounting principles helping those guys massage those numbers. Now, they don't all do it, okay? But enough of them do that I just don't want to rely on that anymore. Okay, so I'd rather look at the operating income or a rough estimate of cash flow. And then you can find out what the entire business is selling for. That's a real number. That's a real number. It has nothing to do with a feeling. It has nothing to do with, an instinct or I got a hunch. You do that long enough. And here's the bad thing about playing hunches. You play a hunch, okay, and you get lucky and you make money, but you don't recognize it's luck because you had a hunch. You think you're onto something now. And that will work all the way up until it doesn't. And then your hunches are going to go bad. And then you're going to feel bad. My suggestion is don't go that way. Don't take those steps. This is too important. Investing is much too important to leave to hunches. Now, if you want to take a small amount of money and do something like that, great, do it. But understand that if you make money that way, it's going to be luck. It's not going to be skill. And it's not going to be from measuring or from looking at pieces of information that you can know for sure. Because you can't, measuring hunches is incredibly difficult to do. But I can take a look and see how much cash the company's generated over the past 12 months. That's an easy one. I can take a look and I can see what the current market value of that entire company is. By the way, that's part of the book, Ben Graham's philosophy. If you wouldn't own the entire business, you don't have any business owning a single share. Now think about that for a second. I've gotten a lot of kickback on this during my career when I tell people, you describe yourself as an investor, as most people do. But when I lay out that little idea of, you should try to figure out what the entire business is worth. And then would you pay the current asking price based on what you've estimated to be the actual business value? And if you wouldn't buy the entire thing, then you shouldn't buy a single share. And I get a lot of people say, well, I'm not going to buy the whole thing. Well, it doesn't matter, you see, because when you buy a piece of it, you're buying a piece of that business, and the value is what you're going to get. The price is what you're going to pay. Now, you may overpay. You may pay too high of a price. If you don't know how to estimate what the fair market value should be, you are lost. You're guessing. And you're measuring based on gut feel, instinct. Typically, if you're buying a stock, it's warm, fuzzy feelings. And that's really difficult to make money with consistently. So I'd rather rely on things. And that's what Ben Graham did. Ben Graham was actually a quant. If you were around today, they would call him a quant. What is a quant? A quant is somebody who uses math to make their investment decisions. Why? Because math is unemotional. The numbers are the numbers. You can measure them. Why did he do that? Because he saw how emotional the market was, and he knew he had to put down a framework to be able to navigate through those storms. Those are emotional storms, by the way. The share prices are just a reflection of the current emotional environment in the stock market. That's not a load of crap. That is a fact. And I can prove it to you. You want to call me up and set an appointment, I will prove it to you. And if you want to bet on it, I'll take bets up to $10,000. That's how sure I am of that. Market's measuring the current emotional sentiment. And occasionally, it'll have it right. I'd say right now, it's got it really right. Maybe slightly on the positive side if you're looking at super large mega cap stocks. Yeah, if you're looking at medium-sized companies, mid-sized and smaller sized, I think there are a lot of good values out there. I know how to find them. Actually, I've already found them. You use a dividend model. You use the cash flow model, the one we're going to be talking about at the seminar. Those are great tools. And I have no doubt in my mind, if I were able to bring back Ben Graham, somehow bring him back from the dead, and I showed him what I was doing, I have no doubt in my mind that he would approve. None. And it has been made, by the way, the reason I can do this, he hired, one of the reasons Warren Buffett had a job working for him was because they used to do all this stuff by hand. They would go looking through these S&P tear sheets. Standard & Poor's used to put out all the financial statements in books that they updated constantly because companies were constantly updating their records, minimally once a quarter. So they would go through these books looking for criteria by hand. So he would split up the stocks alphabetically. Hey, Buffett, you're going to take A through F. And Schloss, you're going to take F through M. And they would just work through those names, looking for things, stocks that met certain criteria, and they had to do it by hand. So today I'm doing it with a computer and a database. That's very expensive, by the way. There are some databases out there that are not quite as expensive that would allow you to do this. Although quite frankly, I haven't found one that I would trust. So if you're going to do what I'm doing, you'll have to do it the way that Warren Buffett was doing it back when he worked for Ben Graham. You're going to have to go through those companies one at a time. I remember somebody asking Warren Buffett once, because he had said that he'd read every single publicly traded company. I was talking about companies that were traded on the New York Stock Exchange, and some of the bigger, and NASDAQ wasn't as big a deal back then. And they asked him if what they should do. He said, well, you could do what I did and just read all the financial statements from all the publicly traded companies. And they go, wow, there are several thousand. How do you suggest I get started? And he said, well, you should start with the A's. Because you can track. I'm assuming that's what he meant. And by the way, I paraphrased that. So those weren't the exact words, but that was the meaning. Start with the A's. Yeah, it's a lot of work. And that's what those guys did. So today, fortunately, we don't have to do those sorts of things. Today, I write a little bit of code, actually with the help from Bloomberg, because their database doesn't work like a lot of the other databases, so you got to have help from them. And we pull out the companies whose operating income, that's basically a version of cash flow, not comprehensive, by the way. So all you CPAs out there, don't get riled up. It's just a loose description. It gives us a good number. The number is a little easier to extract now with all the software. And we can take the value of the company, that's the value of the stock plus the debt minus the cash, because you get the cash cap back if you buy the whole company. They call that enterprise value. So we can take the enterprise value, or the value of the entire company, you divide it by the operating income, and it gives you a yield. Just now we can compare companies across different industries. And although banks and some financial stocks are much harder to do this way, so I would you got to be careful with that, by the way. But now I hear the music. That means I've talked all the way through the first session here, and I've got to take a commercial break. You're listening to Bill Bullington right here on 1420 The Answer. I'll be back after these commercial messages. And we're back. Hey, if you'd like to call us, 216-901-0945. You're listening to Bill Bullington. I'm here every Saturday morning from 11 to noon, 1420 The Answer. They replay this show tomorrow. And by the way, it's also available on Apple iTunes as a podcast. So feel free to contact us. And I'm going to take a call right now. I got Jerry. Jerry, how you doing?
Good morning, Professor Bullington.
Oh, yeah. Don't know if I deserve that, but
I'm here to be tutored on how to increase my portfolio size.
Okay.
All right. AAOI, that was one of your stocks that recently has been listed into one of the momentum stocks of the last 3 weeks or so. How do you feel that's going? Do you think it's got a lot more gas into it?
You never know that, Jerry. Actually, you don't know if a mutual fund or a hedge fund has a big position on that maybe they bought it down around $9 or so, or maybe around $14 or $15. And then they may want to unload that thing. And if they've got enough shares in it, it's going to drop pretty quickly. So you don't know where a stock is going to go. To make a projection like that is you just, if you got it right, you would just be lucky. So what I can tell you is that, it showed up on the scan. And if you bought it, depending on how you're going to trail your stops, I would say I would use a 15% minimum trailing stop, somewhere between 15 and 20. I like to use that or the lowest price it's traded at over the past 3 to 4 weeks. And because that thing is running like really fast.
Yes, it is.
That was $9 in May. It's at 30.
Yeah. Yeah.
That's a big move.
Yes, it is. I mean, if it gets hit, it could stand a pretty good walloping too, I assume.
Yeah, they all can, but the price to sales ratio is really not that high on that. So
that's what I noticed, Bill. It seems to be fairly,
And I gotta tell you, a lot of semiconductor stocks are running right now. One of the reasons that they're running right now is the new cars are literally computers on wheels.
Okay.
The big demand for a lot of semiconductors is in cars. And you've got PCs, you got smartphones. Those always need a lot of, they have a ton of semiconductors. Everybody's aware of that. But what they're not aware of is the cars. And it's unbelievable how good the cars are getting with their technology. It's mind-boggling. I took my car in. My car's only, 3.5? Is it 3.5? It's almost 4 years old. And when I look at the technology I had, which was top of the line at that time, and how much it's progressed just in the last 3.5 years, I'm going, wow. It blows my mind. So that's where the big demand for semiconductors is really coming from. Well, a large portion of it is coming from cars.
So it's momentum. It could also be value then,
yes,
right?
Absolutely. That's what I like the best. When I see those two things combining, that's when I generally will buy a 5% position for the trading account instead of a smaller one. And if it goes up right away, I'll actually increase my holding as the stock moves higher. Yep.
Okay.
Averaging
that's
up
kind
is
of out of character, isn't it?
Nope. That's averaging up. And that's what professional traders do. People who aren't professional traders don't know to do that. I just lost my hearing ability. I'm going to have to switch real quick.
Okay.
Hang on for a second. Yeah. My headset just broke.
Uh-oh.
Can you hear me?
Oh, yeah.
Okay. Now I can hear again. My headset just broke in the middle of our conversation. So, I really don't, I forgot what we were talking about. But
we're talking about momentum and
value
stocks combined.
Yeah. And I prefer to do things that way. And also, when a stock jumps up right away, I will generally increase my position in it. Most people want to take a really quick profit. That's why they never really make a lot of money. Because the ones that take off right away tend to be your biggest winners. And if you're cutting back on that or cutting the profits short, now you're leaving yourself with small profits and a whole bunch of losses on your crappy trades. So it's very difficult. But if you have just bought this, I'd probably put my stop about 10 to 15% away and just let it rip.
Okay. Now, totally different industry, but same idea. How about Box? How are you doing with that?
I have a profit in it. It's a small profit. I didn't buy it that long ago. I bought it when it was up more than 3% in a day. It comes up, and also when I looked at the chart, it was approaching its 52-week high, which right now it's actually through. So at this point, I just have a trailing stop on it, and if it goes, it goes. If it doesn't, it doesn't. But I want to make sure that everybody understands that this is a trading account. This is not an investing account.
Understood. Which one would you consider more of a risky stock? Box?
Box has a higher valuation than.
That's right. That's what I thought. AAOI, which I can't even pronounce the name of the thing. As I said, seems to be fairly conservative.
Well, from the value, but
valuation. Yeah.
But their business is actually more cyclical, and the margins aren't quite as high as Box's are either. So there's some compensating factors there.
Okay, how about GM versus Ford as an investment?
You know what? Both those stocks have been in the high dividend model, and now one of them's in the B-cap value. I think it's Ford's in the B-cap value model. But as far as that goes, those types of stocks, I let the models pick those stocks. I don't try to pick those anymore. It's too hard. As long as it meets the criteria, either the dividend yield is really high or the cash flow relative to the business value is really high, then we'll own it. But if the cash flow or the dividends drop, it'll get cut. If the share price goes up, that doesn't mean that the dividend's going to go up as much as it never does. So the dividend yield will drop, the cash flow yield will drop, and that model will actually take profits on those stocks. So I have that all built into that model. It tells me when to buy and sell both GM and Ford.
Okay.
So I can tell you that I think Ford is still in one of them. I'm not sure if GM is, but I know it was. I'd actually have to look it up.
Okay. About 6 months ago, you said Colgate was overvalued. Since at that point it was $72.73. Since then, it's dropped down to about $64, which you were right on the mark with that. How about if I have some extra cash? How about selling some puts on Colgate?
I'm going to have to stay away from steering anybody towards options. I had an experience just yesterday.
Okay.
Guy calls and he's talking to somebody at Fidelity, and he doesn't know what this guy's saying. I don't know what this guy's saying. I don't know what's being interpreted, and I feel really bad because this is a really good client for a long time, and he's confused, and he's on vacation, and he's trying to learn. He's it's expiration day, and this guy's giving him some bad information.
Oh, jeez.
Or he is misinterpreting what the guy's saying, and what he's telling me is not possible, by the way. And I'm just going, oh, geez. So it probably ended up costing him a little bit more money, and I feel really bad about that. So I just can't. People won't have the expectation that I'm going to be able to hold their hand and walk them through every transaction.
Right.
And
I understand where you're coming from. It's not for everybody.
No.
How about just in general, Colgate? I mean, it's down, getting closer toward the bottom of its trading range, although it's been lower. There's a lot to risk in it at this price.
Well, it's still a stock.
I understand that, Professor, but it's a good, solid performer. It has a decent dividend.
I
think there's much risk in it, or
no? Yeah, it's got a lot of
More
risk.
so than a lot of stocks.
Less than a lot of stocks. Let's put it that way. But if it's not in one of my models, I'm not owning it.
Okay.
I only want the models that meet all the criteria. Mm-hmm. If they don't meet all the criteria, then I don't want it. Okay,
one last question, if I may.
Sure.
Rail, what's happened to it? What's going on?
It's right around. I think it's down probably 3 or 4% from where I bought it, and nothing's going on. Actually, it got a nice bump when Trump got elected. But actually, the tangible book value on that is not too far away. Actually, I think it's slightly higher than the share price is. I think it's somewhere around $17 or so. And a large portion of their book value is cash. So it's just a value stock. It's just kind of going sideways, and that's what you'd expect. I'd expect at some point in time that maybe one of their competitors just wants to buy them out because they do have an awful lot of revenue, and they've got a lot of cash, and they would be able to absorb part of the competition. And really
makes sense. Makes sense.
And it wouldn't cost them a lot of money. I mean, if they were to buy
the money right,
So at some point in time, but you never know. That's one of those stocks that I hope doesn't turn into what is known in the industry as a value trap, because that stock can stay low for a really long time.
Yeah. But, I mean, unless you're a real long time investor and got a lot of patience, it's probably something I'd stay away from.
And I have a very, very, very small amount of it, so it's not a big deal.
Okay, very good. Nice talking with you this morning, Bill.
Thanks for calling.
Man.
Yep, you too.
Yep.
And I'm going to go right to John. John, you have a question for us?
Good morning.
Morning.
I hope if you can accept retroactive taxes and continuing resolution, I hope you'll accept my retroactive Happy New Year.
Sure.
Okay?
Yep.
And now, could you touch at least the Senate hearing, the new nominee? At least he was upfront, said, I'm not going to wait until the last minute for raising the debt ceiling. I thought that was a pretty good way to assure everybody. And number two, could you touch on, for all the hoopla, we forget the fact that as super anchor of the financial world, America's dollar is the reserve currency. Along with that comes a few things we don't even discuss. So it's too many moving parts. So you may want to touch on that.
Sure. That sounds good. I'll try to get to those things. I got to take another caller real quick right away.
Sure.
I'll try to follow back. Thanks, John. Thanks for calling.
Bye-bye.
And Chris.
Hi.
How are you doing?
Hey, good. Hey, first question my wife wants me to ask. You don't have tickets to the Nari Home Improvement Show left, do you?
You know what? I can certainly ask. I think I can probably get them.
Okay.
So after the phone call, hang on.
Okay.
I'll have the board operator take your name, and
Okay.
they leave them at the Nari booth when you walk in. It actually wasn't at Will Call. It was actually at the Nari booth when you walk
Nari
in.
booth.
Yeah. So
Okay, and then we just say it's under your name too then? Okay.
no, actually, just give them your name.
Your name. Okay.
Because under your name, we're going to. That's where we'll have the tickets left.
I think it's over tomorrow, so.
Yeah.
Okay.
So I'll give it a shot. And,
all right, great.
all right.
But I do have a stock question.
Sure.
Hey, my stock buying, and this is really trading, so I'm not looking at long-term investment.
Sure. Okay.
But my philosophy has been buy larger companies, report great earnings, and it never fails that the minute they do that, the stock sells off, and then I buy it. And the latest one I'm looking at, I did this with Disney and I did it with Apple, and I've sold those now. But now I'm looking at J.P. Morgan, which had outstanding earnings, and now it's like everybody hates the stock, and it's originally it bumps like $2-3, then it falls down to about $5. I think it's like 83, 3.5 or something. I mean, do you see any downside on these banks at this point? It seems like
they're all
they're all
seems
stocks. Like they can only get. Yeah, but it seems like they seem going forward. They can only get better right now, even. And if they had, I don't know, unless J.P. Morgan had great earnings for a reason that, just one reason. I don't know.
Yeah. See, that's one of the reasons. As a trade, I have a very specific style. And my style would, if J.P. Morgan were to come up on one of the screens, I could use it. In fact, I can tell you the last time it did come up because it came up. But it was actually in November, right after the election. The stock catapulted, came up on the scan, $73.08. And today, you would have gotten stopped out of it last Tuesday at $83. So,
which is where it's at now.
Yeah. Had you taken that trade, if you had taken that trade, that's a pretty good gain. That's about 14% or so in a few weeks. So that's my style. So the reason I wouldn't do anything other than that, and actually, can you hang on? I'll have to come back to this. Okay. Thanks. Sure. And you are listening to Bill Bullington right here on 1420 The Answer. We'll be back after these messages. And we're back. That commercial break was so long, I forgot what we were talking about.
Well, we're talking about J.P. Morgan, and when I say it's a trading account, I don't mind holding it for like 3 to 6 months, say. Yeah. And I'm looking at their earnings, and the stock drops after really great earnings. And it has a nice dividend too, like 2.25 or something.
Traders never pay attention to dividends. I mean, they never do.
Well.
But
I'm looking at the dividend only from the standpoint that eventually it can't drop too far with a dividend, because if the dividend keeps going up, then you'll probably have more interest.
Well, here's what I would do. I would try to set. You have to set some sort of risk parameters. Like if it goes down a certain percentage, you're going to get out. And then you have to have some sort of a method of taking profits.
That's the hard part.
Yes, and if it's
when do you sell?
and if it's not written down, then you don't have one. If you can't explain exactly when you're going to exit that stock, then you don't have one, and you need that. If you're going to trade, you're going to need that. Now, the fact that you're sticking with these higher quality names will bail you out and prevent you from losing a lot of money in most cases. But you need to just develop a little bit more direction, because what I'm hearing is that there's a portion. It's called a setup. Traders call what you're talking about a setup. They've announced earnings and the stock comes down. That's the setup. Now you need to exit with your loss strategy and how to take profits. The last part of that is position sizing, how much money you're actually going to put in it relative to the size of the portfolio, so that you can keep playing after you've suffered several losses in a row. Yeah.
Okay.
So that's what I would say is you need to develop those other ideas, because right now you've only got a portion of what you're of what you really need.
Yeah. Well, I know where I will sell it, and it's not a huge gain. I mean, it'd be like a $3-4 increase from the 83 if it goes up fast.
Yeah.
I would
Well,
get
see,
out.
all these that when you say if it goes up fast, is that 3% a day? 10% a day? The all that stuff.
Well, yeah, I would say 10% in a couple of weeks. I would get out. I would just dump it.
Okay, 10% in a couple. Here's here's the problem with that, and I'm just trying to help you out. I'm not trying to make you feel bad.
Okay.
Right. You're going to take a 10% profit inevitably. If you do this long enough, you're going to buy a stock, and it's going to open 20 or 30% lower than you bought it for. If you haven't had that happen to you already, it's because you're not really trading that frequently. If you have had it, then you know what I'm talking about. So if you track the performance of that account over time, it's not going to be a stellar account, because you're taking small gains and you're open to very large losses, and sooner or later those large losses show up. Now, I saw a guy that went for 22 years without a large loss, and then wiped his fund out and the firm that was clearing his trades out in a day. He went for 22 years. This guy had a PhD in statistics, and everybody thought he walked on water, and he thought he walked on water. Eventually, that comes home to roost, and I hope that never happens to anybody. But the reality is, if you're taking small profits, then you better be taking even smaller losses. And that's what this guy was doing. He was taking a lot of small profits, tons of them. Every month, he was profiting about anywhere between 1 and 1.5%. That's what he was shooting for. But the risk that he was taking, the unusual, the outlier that was almost never supposed to happen, finally showed up after 22 years. And the reason I know so much about that is I had accounts at the brokerage firm that he bankrupted and ended up taking a 30% haircut on my account. I had done nothing wrong. I hadn't lost any money, but he lost so much money that the brokerage firm's net capital was affected. And when they paid out all the accounts, I got less than I had in my account. And so this is why I'm spending so much time on this right now. Nobody ever thinks it's going to happen to them. Don't shoot for small profits. Shoot for large profits.
Okay.
And unless you've got the money to put in a high-frequency trading program, and then you can shoot for, fractions of a penny. But to do that, you've got to have a couple $1 billion. and if I had a couple $1 billion, by the way, I wouldn't spend the money wasting it on a high-frequency trading program. I would be doing something else. But anyway, I hear what I get what you're trying to do, by the way, and it shows that you actually have observed a lot of what's happening in markets, because watching a stock's reaction to the earnings report is that's pretty astute. You just have to add a couple more things there to complete that.
Well, it seems to happen all. It's like Apple. Now, Apple can come out next week or whenever it is, at the 30th or something. That's why I sold it. They can come out, blow out the earnings, beat everything in the world, and then just make one comment about the future, and they go, "Oh, this sucks," and they sell the stock down 10%.
Yeah, you'll see that.
And I don't want to lose the gains I had, so I'll sell it before they release the earnings. So.
Yeah, well, that's actually, those are called anomalies, and what people do, there are people who literally go around trying to find those anomalies, and they measure how long and how effective they're working. And when the effectiveness starts to dry up, they stop doing it. So what you found is an anomaly, and there's no telling just exactly how long that anomaly will stay in place before it changes again.
Yeah.
So that
seems to happen a lot. That's why.
It seems to happen because
I've been watching stocks a lot.
Yeah, it's most recent in your memory. and it has failed a gazillion times. If you took that strategy, I promise you, and you applied it to the late 1990s, you'd have gotten your butt handed to you. You'd have been so sorry because the companies that you did buy or sold went way up. The companies that came down after an earnings announcement used to crash. The companies that came out and were ahead of their earnings announcement, those things would catapult. And so if you were looking for that pullback, it never happened unless it was a major crash. So because I too have been looking at charts and earnings for last 30 years. That's how I know that the anomalies tend to change. They tend to shift over time. It's never, by the way, it's never very quick. It slowly erodes and degrades. That's why most of the guys that do that are statisticians, because they're keeping an enormous amount of data on all that stuff, and they're watching it all the time. And it's one of the reasons that I developed these other investment models, because the other ones, they're more robust. They're not really focused in too heavily on an anomaly. Actually, the one that's focused most on an anomaly in my portfolio is the momentum model. And over time, I'm sure at some point in time, I'll probably have to adjust that. But right now, it's still effective. It's been very effective. And I've used some form of that for a very long time. But I've had to modify that because the market conditions change. They don't change radically, but they do change. And when you look at small changes over like 5 or 10 years, it adds up to a fairly significant change, but it doesn't do it really quickly. So, but my hat's off to you, because just noticing what you've noticed, you are watching stocks a lot closer than most people ever will.
Yeah, well, I do, and I learned my lesson on the small stocks. I mean, Box is one I've watched from $9 up, as you mentioned.
Sure.
I've never bought it because I've always seemed to get burned in a small stock. Especially companies that aren't making money.
Oh, this one's making. They're making money, by the way. Their cash flow is huge.
Who, Box?
Yeah.
Well, I thought their earnings were still negative.
That's because you were looking at the earnings. I spent the whole.
Okay.
Yeah.
Okay.
When you look at the cash flow
Well, anyway.
Heavy. Yeah.
Okay. Well, anyway, I try to avoid for the most part any of these small companies because I just don't.
The small companies will move a lot faster. Yeah.
Oh, yeah, you can lose 50% fast.
Oh, you could be down 70 or 80%. Yep, absolutely.
I know. So I kind of stick with the large companies because somebody's going to own them at some price. It's not like the company's going out of business. Unless it's AIG
or GM.
Yeah. Well,
I got to take a real...
Okay, I'll see you.
All right, thanks. You've been listening to Bill Bullington here every Saturday morning from 11 to noon, 1420 The Answer. Have a good week, everybody. Good luck and good investing.
You just caught another episode of the Bullington Capital Report, broadcasting every Saturday morning at 11 a.m. on AM 1420 The Answer. If you have a question and would like to speak to Bill personally, you can call him at 330-664-0700. That's 330-664-0700. Or contact him through his website, bullingtoncapital.com. That's bullingtoncapital.com.
Past performance may not be indicative of future results. Therefore, no current or prospective client should assume that the future performance of any specific investment strategy, including the investments and/or investment strategies recommended and/or purchased by advisor, or product made reference to directly or indirectly, will be profitable. Different types of investment involve varying degrees of risk, and there can be no assurance that any specific investment will either be suitable or profitable for a client's investment portfolio. No client or prospective client should assume that any information presented serves as the receipt of or substitute for personalized investment advice from the advisor or any other investment professional.
The preceding program has been paid for by Bullington Capital Management, LLC.
The preceding program's views, claims, or representations may not reflect those of AM 1420 The Answer or Salem Media Group.